Good afternoon and welcome to the Pressure Technologies preliminary results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab that's situated on the right-hand corner of your screen. Please simply at any time type your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I would like to submit to the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand over to James Locking, CFO, and Chris Waters, CEO from Pressure Technologies. Good afternoon to you both.
Good afternoon, Mark. Thank you for the introduction.
Good afternoon, Mark, and welcome everybody.
It's great to be on the Investor Meet Company platform this afternoon. Pressure Technologies, as well as really strong support from its institutional shareholders, has a long history of strong support from private shareholders, individuals holding stock in the company, and we're delighted to use IMC to get our preliminary results for 2021, that message across this afternoon. I'm going to turn to our first slide and give an overview of the Pressure Technologies Group, our group. Now, very much a leading UK designer and manufacturer of safety critical components and systems serving global supply chains in defence, oil and gas, and industrial hydrogen energy markets. We now have two divisions within the group, the Chesterfield Special Cylinders division, the cornerstone of Pressure Technologies, and the Precision Machine Components, the PMC division. Chesterfield Special Cylinders was established back in 1897. It's fundamentally involved in the manufacturing of safety critical gas containment systems, also their inspection and recertification. We serve global defence, oil and gas, and industrial customers, and we're seeing increasingly a growing market in hydrogen energy, which Chesterfield has an increasing presence in. Our Precision Machine Components division comprises today of the Elmet, Router, and Martract brands. We manufacture highly specialized precision components for complex safety critical applications, principally in oil and gas. Those components are serving drilling, well intervention, production flow control activities. Again, we have a global oil and gas OEM customer base. As you can see in the photographs in the slides there, the manufacturing processes at both our Chesterfield Special Cylinders and our Precision Machine Components sites, and the range of components that we are delivering to significant OEM customers. Our sites are in the UK. Our operations are based in England and Wales. And in Wales, we have our Elmet facility, Pontyclun near Cardiff. Our Chesterfield Special Cylinders site is based here, where James and I are today in Sheffield. Our Router facility is a short distance from the Chesterfield Special Cylinder site in Rotherham, and our Martract facility is in Barton on Humber. All told, the group today has around 190 staff distributed across the four operational sites. James and I joined the group in 2000 late 2018, early 2019. And in 2019, in June 2019, we launched our growth strategy for the group. Previous growth strategy for the group was one very much based on diversification through acquisition. The strategy today, as launched in 2019, is about the delivery of organic growth from our two core manufacturing divisions of Chesterfield Cylinders and Precision Machine Components. The first phase of that strategy was initiated in 2019, and it was very much about refocusing the group on getting the very best from those core manufacturing divisions. It was about the divestment of non-core activities, the divestment and sale, divestment of the Hydrotron engineered products business, and the Green Lane biogas business was also divested, and that transaction was completed in 2019. The focus in our phase 2 of the strategy was very much about extending the range of products we are offering to our existing customers, and extending also the base of customers that the group served. A traditional organic growth strategy, but that strategy was also about getting the very best efficiency, productivity, performance, and profitability from the sites that we're operating through operational improvement to support growth in profitability and cash generation. Ultimately, the completion or extension of our organic growth strategy would give the group the opportunity to accelerate growth further through potentially acquisition, partnership, and the building of scale. And we made significant progress over the last 3 years of implementing this strategy. Of course, 2 of those years have sadly been hampered by oil and gas market conditions, which have constrained the growth and development, in particular of our PMC division, that felt the brunt of that. But nevertheless, we have pushed on during phase 1 and phase 2 with the performance improvements across our operation, involving the implementation of capital expenditure plans to improve our equipment and facilities, and also, very importantly, the strengthening of our management teams and our specialist skills and capabilities across the business in sales and engineering. And we've seen the benefits also of a transformation of organizational culture during that period. So progress being made, notwithstanding the challenges of the last 2 years' impact on our operations and our end markets. But nonetheless, progress and strong progress. In addition to the organic growth from well-established markets, we've also seen very strong growth in an exciting market in hydrogen energy storage, and we'll talk more about the growth and development in that market later on in the slides today. Moving on to the group highlights, in particular for the year ending 2nd of October 2021. I'm going to talk about the headlines. James is going to then talk about the financial details. 2021, despite the challenges and the disruptive backdrop caused by COVID-19 and oil and gas market conditions, we were pleased with the overall progress in the group, and the revenue delivered £25.3 million, an adjusted operating loss of £0.7 million. That performance was underpinned by very strong revenue and profit in our Chesterfield Special Cylinders division, which sought to offset some of the results in our Precision Machine Components division. Chesterfield Cylinders order book underpinned their very strong revenue of £18.9 million and a very strong EBITDA of £3.5 million for Chesterfield in that period, significantly up on the previous year, 0.6 million EBITDA. In our Precision Machine Components division, oil and gas trading conditions drove that 55% reduction in revenue, just down to £6.4 million, around £8 million worth of revenue drop compared to the previous year, but only £1 million worth of impact on EBITDA as a result of steps taken promptly at the early stages of 2020 to mitigate the losses, or to mitigate the impact of the oil and gas market on our operations. So during the period, we have seen some strong progress, in particular momentum building in the hydrogen energy market, where our revenue grew from 0.2 million in 2020 to 2.2 million. We've seen the tremendous success for our highly competitive, efficient designs for hydrogen storage, and that's something we'll talk about later on in the slide deck. Fundamentally important to underpinning our growth in the hydrogen energy market has been collaboration with our two core steel tube suppliers, Tenaris and Valorec. We also have continued to progress the investment necessary to meet the future growth in demand at our factory here in Chesterfield Special Cylinders. Funds raised during our very successful funding round in December 2020. Notwithstanding the impact of oil and gas markets on our precision machine components business, we have continued to press on with the improvements, our strategic improvements set out in phase 2, the improved efficiency through the implementation of new advanced equipment, production engineering methods, the implementation of manufacturing systems, and the use of data in the management of our manufacturing operations, and the significant extension of our customer base and extension of the range of products that we offer in that division. So all of the strategic focus areas for development of our PMC division have been progressed, notwithstanding the impact of the difficult market conditions in oil and gas. We also, during the period, implemented an extension of our banking facilities with Lloyds Bank, extending the facility through until June 2023. So some good progress made despite the backdrop of difficult market conditions in oil and gas, but the strength of Chesterfield Cylinders business in established and new exciting hydrogen market was seen during the period. I'm going to ask James to talk about the group financial results.
Thanks, Chris. Okay, so as Chris said, the revenue was very similar to the previous year, but more importantly, our gross profit improved from 5.3 million to 6.7 million because of that improved performance in the CSC division. Obviously, our operating loss for the year was at 0.7 million compared to 2.4 million in the prior year. And I think key, if you look on the graphs on the right-hand side there, you can clearly see the bottom right graph, revenue by market sector, that shows that balance of revenue split between our four major sectors. So you can clearly see the dark blue color is the oil and gas, the red is the defense, yellow is the industrial market, and the green top of the right hand FY21 bar is the hydrogen market. So you can clearly see we're starting to see that defense growth in revenue from the previous two years. Industrial revenues remaining similar to around £4 million per annum, but the hydrogen market revenue of 2 million coming into 21, and that we hope will continue to grow going forwards. Okay. For Chesterfield Cylinders standalone division, that, as Chris said, their revenue is up by nearly 70% to 18.9 million compared to 11 million in the previous year. That allowed them to double their gross profit to 6.1 million from 2.9 and make an adjusted operating profit of 2.8 million, which was compared to a very small loss the previous year of just under £100,000 loss. That, more importantly, their gross margin went up as well, 32% compared to the previous 26. And that, as you can see on the graph on the right hand side there, you can clearly see the impact of the defence revenues and the hydrogen revenues on Chesterfield Special Cylinders, and how that's allowed them to grow. In the top graph, their gross margin came back up on the higher revenue and the basis of the defence contracts and hydrogen contracts that we've got. And I'll let Chris talk to you a bit more about the progress made in the division.
Thanks, James. Yes, just a few highlights from FY 2021. As we've seen already, very strong contribution from our defence contract revenues at Chesterfield Special Cylinders. That £11.1 million worth of revenue driven by UK and overseas naval submarine programs for the likes of BAE Systems and Naval Group. The revenue from hydrogen grew to 2.2 million from a low base in 2020 from contracts from key customers Haskell, McPhee, Framatome, Arcola, and US fuel cell major Plug Power, where we've been able to establish the very successful Chesterfield Special Cylinders design as the specified product for hydrogen refueling stations for these customers. We also saw in the period the first 2 orders placed by Shell under a 5-year frame agreement that we established in June 2020 to supply their European refueling stations, and those projects are ongoing in Chesterfield for delivery within 2022. We've also, to underpin the growth and production improvements at Chesterfield Cylinders, implemented a series of process and system improvements in our manufacturing operations, and those have progressed under a new management team throughout 2021 and will continue through 2022, as we will also continue to implement the capital investment program that will also underpin the delivery of our longer lead time defence contracts, alongside the shorter lead time and higher volumes of high pressure hydrogen storage. In terms of the outlook for Chesterfield Cylinders looking into 2022 and beyond, Chesterfield has a very strong defence order book and a very visible pipeline. In some cases, that pipeline extending well beyond 5 years, which supports the capacity planning within Chesterfield Cylinders. It's also high value. High value. The defence contracts very high value for Chesterfield, and we also support a number of our naval customers with integrity management. That's the in situ inspection and recertification of high pressure systems on board naval submarines and surface vessels, for which again we get very good visibility of those contracts. Also in the outlook, we're very pleased with so far the development of our products for the hydrogen energy market, the pressurized storage of hydrogen energy for refueling stations, green hydrogen storage, and mobile transportation. So very good progress made so far, and we're getting increasingly strong visibility of opportunities in that market, as we work closer with our key customers to understand their project pipelines for 2022, 23, and beyond. I'm going to just elaborate a bit more here on our defence order book and pipeline. Chesterfield Cylinders supports key customers such as BAE Systems, Naval Group, Rolls-Royce, HDW, ThyssenKrupp, Babcock, for major defence new construction programs for naval submarines and surface vessels. We're pleased to continue to support BAE Systems and the UK Ministry of Defence with the Astute program and the supply of cylinders for the Astute program, also for the Dreadnought new construction program, for which there are four boat sets of cylinders in total. Currently working on the second boat set for BAE Systems. We also support Naval Group, French naval constructor, for in particular their Barracuda, the Barracuda class, and we have good visibility of the outlook of Barracuda class projects. In addition, in the end of 2022, we secured further contracts with BAE Systems for the Type 26 frigate program, and we see also a strong pipeline for Type 26 Hunter class frigates for the Australian and Canadian Navy. In addition to the supply of products for new construction, cylinders for new construction projects, Chesterfield Special Cylinders delivers integrity management services for the naval submarines and surface vessels, where we inspect and recertify cylinders in service. we have, again, good visibility of those programs and their high value, important revenue for the Chesterfield Special Cylinders naval business. Operating for many years in safety critical pressurized storage does position Chesterfield Special Cylinders very well for the growing hydrogen energy storage market, both in terms of hydrogen refueling stations and green hydrogen storage, and the mobile transportation of hydrogen. Customers operating in that space look for the experience and longevity of companies such as Chesterfield Special Cylinders in respect of the design and proven manufacturing capability for the high pressure storage of hydrogen, at some cases at pressures up to 1,000 bar. We've seen strong progress over the past year in that market, and I can share with you here the progress that has been made. As you can see, our important customer base here: Haskell, Shell, McPhee, and Plug Power, as well as Arcola Energy, now part of Ballard, Framatome, and we're seeing increasingly inquiries for green hydrogen storage projects from the likes of Total and Iberdrola. Over the course of the last 2 years, we've been working with our partners to properly understand and size the market for hydrogen storage, and the areas of priority for Chesterfield Special Cylinders are in European mobility for bus and truck, train and logistics applications, where the second phase is looking at mobility solutions in the Americas, Australasia, and the rest of Europe, in particular for green hydrogen storage. And here you can see the very rapid development in this slide, the very rapid development of truck and bus demand for refueling. And this is, we have evaluated through our rigorous analysis and research over the last 2 years. We've determined the volume of hydrogen that will be required for visible mobility projects, in particular for buses and trucks, and that volume of hydrogen will require hydrogen refueling stations across Europe, and we've quantified those. It gives us an identifiable and addressable market for Chesterfield Special Cylinders to focus growth efforts on, and we're seeing the benefits of having developed a very successful 550 bar hydrogen storage solution that meets very well the requirements of bus and heavy duty truck refueling. To underpin the delivery of hydrogen growth at Chesterfield Special Cylinders, it's been necessary for us to make changes, to make improvements to our production capacity and our efficiencies, which we will have in place by the end of 2022. We anticipate, given the market outlook, that there'll be a rapid increase in production requirements from the end of 2023. So very important that we put in place the necessary production capacity and efficiencies to be able to deliver that demand. And for us, very specifically, that's about expanding and improving our finishing lines and upgrading our testing, painting and shop blasting facilities, and also to make sure that we can manage contracts for hydrogen refueling and storage alongside our traditional defence and industrial and oil and gas projects. So we raised funds in December 2020, £7.5 million. We raised and the £1.5 million worth of that was very specifically to increase the production capacity and efficiencies of our Chesterfield Special Cylinders site here in Sheffield. In addition to the production efficiency improvements and capacity improvements, it's been absolutely vital that we develop a deeper and stronger relationship with our key suppliers. And over the past year, I'm pleased to say that we have, both with Tenaris and Valorec, our key specialist steel tube manufacturers, developed very strong relationships, both with both of them, focused on the necessary development of the right products, and also the securing of the necessary stock lead times and consignment stocks in order to meet the customer service levels, the lead times that are required in the hydrogen energy market, which are significantly shorter than our traditional projects for typical defense customers. So I'm going to now move on to the precision machine components performance for the year. But before I do that, one sort of final comment on the hydrogen market for Chesterfield Cylinders in terms of its outlook going into 2022. That the building of our production capacity and the strengthening of relationships with our key suppliers stands us in very good stead to see continued growth and development in this market, and we anticipate a very similar level of growth through 2022 as to that we have seen in or levels of revenue in 2022 to those that we have seen throughout 2021. So very strong, very attractive market, and Chesterfield Special Cylinders has developed over the course of the last 2 years a very attractive, very competitive, and very efficient product for that market, and we look forward to seeing more of its success during 2022. James, I'm going to ask you to talk about the financial results.
Yeah, so for PMC, Precision Machine Components division, obviously, as Chris said earlier, quite a difficult year, both revenue and profit. Obviously, our revenue dropped by 55% down to 6.4 million compared to 14.2 million in the previous year. We made an adjusted operating loss of 1.6 million compared to 0.7 million in the previous year. I think what key for us, though, is coming as the oil and gas market recovers, which I'm sure Chris will come on to shortly. Key for us was that in the year, though, there was a move away from just pure oil and gas revenues, and for the first time that's gone to a significant size, we had over 700,000 of that 6.4 million was from actually revenue delivered to non-oil and gas markets. Some of that revenue was delivered to our CSC division, some of it was delivered to other industrial projects. So starting to see that we can diversify away from oil and gas, but oil and gas, as we say, coming on to shortly, we expect that to recover during 2022. Clearly, as you can see from the bottom right hand graph there, the revenue decrease compared to the previous 4 years was very significant. Okay, Chris, back to you.
Yeah, thanks, James. Yes, no, undoubtedly a tough year, FY21, as was 2020. I think importantly, and perhaps I will just jump back in the slide deck there to make a point about FY20. So financial year 2020 for us started extremely well with around over 15% growth year on year for the half years. Compared to FY20, we were seeing the early stages of improving the diversity of our customer base. We were seeing good sales growth in PMC, but that FY20 was clipped by the start of the pandemic. The second half was hit by that in terms of volume. We had been anticipating around 16 to 17 million pounds in FY20, and FY21, as you can see, very significantly impacted by the drop off in oil and gas demand. Notwithstanding that, as I said, we have been able to continue to make progress with our strategic goals. Those were very much around the diversification of the customer base. Back in 2019 and for the years prior to that, for all the PMC companies, and Almet, Router, Martract, and Quadscot at the time, they were very high customer concentrations. In Router's case, in particular, our Rotherham facility, Router's case, 75% of the revenue came from just one customer back in 2019, and today 4 customers represent 75% of the order book in Router, and we have extended not only the customer base but also extended the range of products and services offered to those customers. During the second half of 2021, we saw the start of a recovery of order intake for our Router and Martract sites. Router and Martract are operating or are manufacturing products that are very specifically focused on well intervention, and those the early signs of recovery we started to see in March last year. That continued throughout the course of the second half of 2021, to the extent that our Router and Martract sites had a very profitable second half of the year, achieving levels of profitability greater than pre-pandemic levels. So we're very encouraged by that, and that situation continues in Router and Martract today, again across a more diversified customer base. However, our Almet site in Pontyclun near Cardiff works almost exclusively for Cameron, a member of the Schlumberger group, and Cameron have felt the impact of oil and gas markets on the demand for their flow control components, and the subsea tree demand fell sharply through 2020 and 2021, and the components that Almet make are very much part of the overall subsea tree assemblies. What we see going into 2022 is the very clearly anticipated recovery in demand for subsea tree construction for key OEM customers such as Baker Hughes, Cameron themselves, Technip, FMC, and we anticipate that the recovery will therefore be strong during 2022 for the components that Almet manufacture. That's the valve, stems, gates, and components that are installed within the subsea trees. We're already seeing the signs of increased inquiry levels and increased order placement through our Almet site, and we're very encouraged by what we see and the anticipated demand coming through from the likes of Cameron and Baker Hughes going into 2022. So it's been a very tough couple of years in oil and gas, and really very significantly impacted the performance in 2021 for PMC. But we're optimistic and looking at the signs of recovery going into in 2022, especially for Almet. And as James says, really important diversification within the revenue for PMC. It's very much part of our strategy launched in 2019, was to reduce the dependency on oil and gas customers as much, oil and gas market as much as we could, to utilize also the strong skills, the expertise of the PMC operations, and we've been pleased to be able to do that across the offshore wind market, defence market, and industrial markets, otherwise including water treatment. And defence markets in particular, there's a great opportunity during 2022 to collaborate with our Chesterfield Cylinders colleagues on defence contracts for UK naval programs supporting BAE Systems. We established over the last 2 years long-term supply agreements with Schlumberger and with Baker Hughes and key customer Expro. We are also in discussions with Halliburton about similar arrangements to underpin the manufacture of valve components at the router site. So it's been very important for us to establish those long-term agreements, which have also allowed us to extend the range of products that we offer to all of them. Those OEM customers, especially through discussions about those long-term agreements, are giving us the very best indication that they can of their outlook during 2022, which has helped us determine the level of resourcing and capacity during the level of capacity required to meet their requirements. Over the course of 2020 and 2021, we had to make some very tough restructuring decisions across the PMC business. We chose to close our Quadscot operation in East Kilbride, a persistently loss-making operation. We consolidated the activities of Quadscot into our router facility. We also had to implement cost-saving restructuring in Almet and router themselves, to the extent that we reduced the cost base within the PMC division to around 40%. But I'm really pleased to say that going into 2022, our router facility is already back at pre-pandemic levels of resourcing, and we're being very successful in our recruitment of new skills and expertise into that operation in order to support the growth that we've started to see and are optimistic about for 2022. So coming to the end of the slides here, I wanted to summarize as we look into 2022. The group is well positioned to take advantage of a very strong defence order book in Chesterfield Special Cylinders, and Chesterfield Special Cylinders also faces this very exciting opportunity in hydrogen energy storage. The importance of oil and gas market recovery, though, is extremely important to our precision machining business, and we're more optimistic about that going into 2022. Having launched our strategy in 2019, which was very much about the organic growth and development of both of our manufacturing divisions, our strategy remains focused very much on that, very much focused on the growth and development of both divisions. Strong defence order book in Chesterfield Cylinders, it underpins the outlook for 2022 for the group. We're very excited about the progress that's been made, having positioned some very strong products in the hydrogen energy market. We're very excited about the prospects for those products in 2022. The visibility of the exciting hydrogen market is improving all the time, with refueling station projects, also green hydrogen storage, and mobile transportation of hydrogen expected to ramp up very sharply from 2023. And our progress over the last year and the plans we have for 2022 will position Chesterfield Special Cylinders very strongly for that market. So there's an element of caution going into 2022 about the recovery of oil and gas markets and macro factors very much outside of our control, but the increasing level of order intake and customer sentiment is very encouraging. And that is the end of the slides, and we've also included in the pack some additional financial summary detail. But Mark, thank you. That's the end of our
Great.
Of our presentation.
Chris, James, thank you very much indeed for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while James and Chris take a few moments to review those questions submitted already, I'd like to remind you the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard, and we'll send you an email when that's ready for your review. James, Chris, we did receive a number of pre-submitted questions from investors, and I can see you've had quite a few coming through the live meeting. So I'll read out a few of these first, if I may. The first one reads as follows: we hear in the prelims great news of new contracts. I see no mention of these new or existing contracts via an RNS. So why do you not release information on these contracts via the RNS service? Why do you only mention them in the results?
Yeah, thanks, Mark. I'm happy to take that one. So we endeavour to communicate our successful securing of contracts, even when those contracts are not material. Of course, if they're material, we're obliged to report them. However, we are also restricted by our customers and what our customers will allow us to communicate. And some of those contracts, I'm afraid, we weren't able to announce them due to the restrictions put on us by the customer.
That's great, thank you. If I may turn to the next one, regarding the current loss-making division PMC, even pre-pandemic in trading, the division was really loss-making. Why do you still retain it?
Yes, I think as we've said, Mark, the board is very much focused on the development and growth of both divisions. And we have seen back in 2019 on around 14 million pounds worth of revenue, the PMC business was a profitable business. And if you take the Almet business as an example, around 7.5 million pounds worth of revenue in 2019, the business made around 1.5 billion pounds worth of operating profit. So the businesses are and can be very, very, very profitable with the right level of volume, and that's what we're waiting to see coming back into the Almet router and Martract facilities. Worth also adding that the improvements that we've made operationally to these businesses don't just necessarily give them the potential to be very profitable and cash generative, that they're also actually operationally performing far better than they were back pre-2019. The businesses themselves are now much more sustainable. They are delivering on-time delivery performance around 90%, whereas back before 2019, that operational performance was delivering on-time delivery around 30% of the time. The quality performance is much greater. Our ability to improve, shorten lead times, enhance profitability of individual components for customers is greater because we're using data and MRP systems and manufacturing resource planning systems that give us the opportunity to modernize and deliver better operational performance. And as we're doing that over a much more diverse customer base, so there's significantly less dependence on just one or two customers. So we are optimistic about the future of recovering profitability and cash generation in PMC.
That's great, thank you. And then I guess the final pre-submitted question, if I may, is would you be able to provide some further details on your general contract terms for CSE, particularly regarding raw material costs? Are you able to pass on price rises to customers?
Yes, thanks, Mark. So I can't give very specific details of individual customer terms. But what I can say is that when we price our products, we do so very much with updated costs from our key suppliers. Our customers know the kind of escalation, kind of inflationary pressures that we face in terms of raw material costs, in terms of labor costs, also in terms of energy costs. And we, as far as material costs are concerned, we do indeed pass on those costs to our customers at the point at which we are establishing the pricing for our products. This is why it's been absolutely essential for us over the past year to establish closer, more strategic partnerships with our key suppliers in Chesterfield Cylinders in particular. That's Tenaris and Valorec.
That's great. Thank you very much indeed. Well, look, that concludes the pre-submitted questions. I'm just mindful of time that we can get through as many of the live questions that have come through. As you can see, investors have submitted quite a few questions throughout today's meeting. Very happy to hand over to you to read out these questions and give a response where it is, of course, appropriate to do so. And perhaps there'll be questions more on the financial tone that I guess for you, James. But again, if I hand back to you perhaps and let you go through those, and I'll pick up from you at the end.
Okay, thanks, Mark. I can see a couple of questions at the top around hydrogen. I think, Chris, do you want to do the first one, the one about the?
Yeah, so I've got one here about the materials and technology used for hydrogen refueling station storage, and I can talk about the product that has been very successful for Chesterfield Cylinders just over the last year. In fact, it is the of the 2.2 million, it is in the entire 2.2 million pounds over 2021 came from our 550 bar Type 1 steel cylinder design of various lengths, various capacities, 500 litres, 1,000 litres and 1,600 litres. It's been a very successful product. And in terms of the question here about what materials and technology are we using, we're using molychrome steel, steel tube, seamless steel tube, in this case manufactured by our supplier Valorec. We receive the tubes here on our Chesterfield Special Cylinders site. We heat and forge the ends of those cylinders, and so after heat treatment and machining and assembly and certification, those cylinders are tested and then taken to the customer's site and installed and alongside their refueling station equipment. So that's those are the technologies that we're using for our Type 1 steel cylinders.
The question from Andrew says, what forecast do we have for hydrogen storage over the next 3 to 5 years? I think over the next couple of years, Andrew, it's fair to say that whilst we made £2 million last year, we'd expect to see that kind of go up to about 3.5 million we anticipate for this financial year. So FY22, again, about a similar level of growth from the previous year, just under £2 million growth in revenue. Beyond that, it starts to get a bit more difficult to judge, as I'm sure you'll anticipate. But basically what we see for 2023 is probably, again, another circa 2 to 3 million on top of that. So we're probably looking at about 6 million in 2023. Forward of that growth, the chart that Chris showed on the slide, which talked about the growth in refueling station potential volumes of stations required, obviously that has an implication for the number of cylinders that we produce. It is quite difficult for us to assess that directly financially, just because of the nature of the market. And I think, Chris, if you want to talk about the market space so that everyone's really clear about that, I think that would. And then question from Michael about the competitive landscape and why would people choose Pressure Technologies. I think you can kind of see that it's kind of the development as the market grows. We'll see that competitive nature, and then there'll be pricing implications kicking in. So we've not really seen our revenue beyond the next couple of years, just for the time being.
So I think the the pacing item at the moment within the industry, within the supply chain, is not just the pressurized storage, but it's also the chillers and the compressors, and the supply chain in that areas is also something that our customers are very conscious of making sure can meet their growth expectations. What's driving the immediate demand for Chesterfield special cylinders is the growth and development of refueling stations. Those principally are related to bus and trucks, but also logistics applications as well. For our Plug Power customer, there it's for them it's the warehouse applications, forklift truck refueling stations as well. And we've evaluated those various areas of the market, principally again in terms of overall hydrogen volume demand. It's buses, it's buses and trucks, and as James says, we would anticipate a similar level of stepping up in 2022. So sort of revenues £3.5 to £4 million for 2022, and then similar levels beyond. After 2025 is when we're expecting very steep demand, where other parts of the supply chain really are able to meet the refueling station manufacturing capacity requirements. There's a question also here from John H. What exposure do you have to rising steel prices? Is the question, and I think so. Answering that in a couple of ways, John. Of course, we've seen over the course of the last year or so very significant steel price rises. Those steel price rises our customers are very aware of the market conditions, and the increasing steel prices, and we have attempted over the last year or so to mitigate those steel price rises through the purchase of strategic material stock, which we started acquiring in early 2021, before the prices really started to rise. We've secured that stock. We've also secured arrangements with our key suppliers for consignment stock, both in ingot terms, but also in raw material steel tube. So when we have supply agreements with our customers, and we keep them informed about the nature of rising prices, and encourage then the securing or allocation of strategic stock that we have in order to mitigate price rises for their projects.
I can see Simon's asked two questions, one around supply chain issues and longer term implications, and one about inflation. I think, as Chris was saying there, Simon, that basically the price rises that we're seeing across energy costs, material costs, etc., we do keep our customers aware of the rising cost implications upon ourselves. Clearly, the majority of our cost is material cost, to be fair, and also people costs. But as we go into commercial contracting, then we're aware of our latest cost position, and we are able to quote and pass on costs where we're contractually allowed to do so. So I think
Simon's also asked a question about general supply chain
yes.
Issues and any longer term implications. I mean, we have established the long-term supply agreement last year with Valorec, which has been very important for our steel tube. The steel tube we purchase for the hydrogen projects, but other supply chain issues, the supply chain disruptions we saw early in 2020. We're not a just-in-time organization, so we can accommodate variations in terms of raw material lead times, providing we have sufficient notice. But there were disruptions, logistics disruptions during the early part of 2021. We've seen those stabilize for us during the latter part of 2021. And so the arrangements that we have put in place with our key suppliers are there very much to mitigate the supply chain issues. If we can give our key suppliers a good indication of the likely project demand ahead, it allows them, of course, to manage their production plans and meet our demand.
Chris,
you're gone, Mark. Sorry, go on.
No, I was just going to say we're just coming up to the hour, and I'm mindful for every very good question that you seem to answer. There's another one or two that comes through at you. So I was just going to suggest maybe if there's a final question, then of course we can make available to you any question that's been submitted today, and obviously you can review those at your leisure.
I think
just mindful of your time.
Thanks.
Are you happy to do this, Chris, or do you want me to do it? I mean, there's a question just about oil and gas, just to give just a different question away from hydrogen. So Simon, I think it is you again, same person. What sort of level do you think the oil and gas business could get back to, and how affected by the scrapping of new projects? If I take the first part of that question, I think, Simon, it's going to take a bit of time to get back to the 14-15 million level, but we certainly think that this year revenue should be around 10 million in 2022, and we hope beyond that, sort of 2023, 2024, it could well be back up. But obviously, as Chris said, whilst we're cautious around the pace of recovery, we feel that there is a good sign that could be the case, that we could get back up towards 12 million by 2023, and maybe beyond that, back up to the 14-15 million numbers that we've seen previously. But for this year, around 12 million. Do you want to take the bit about scrapping of new projects, Chris? I mean, I don't think there's anything that it's starting to now be a backlog, and then we're starting to see these projects coming back online now, aren't we?
Yes, I think new construction projects are typically sanctioned at oil prices above $60. We see oil prices now at just over $80, and our key OEM customers favor oil prices in that 75 around $75 to $80 as being a good stable position to be in. It allows continued sanctioning of capex projects in most regions. So that's what is we believe driving the anticipated increase in demand for subsea tree infrastructure during 2022, 23, and 2024. Our Almet and Router businesses supported by Martract are not just supporting new construction projects, though they are also supporting OPEX, or operational expenditure, for the replacement of wear parts, whether it's valve assemblies, chokes, or stems. The components that Almet, Router, and Martract manufacture are also supporting ongoing production levels, and as those production levels rise, then the quantity of wear parts for replacement also increases as well.
That's great, Chris, James. Thank you very much indeed, and I think you've taken all we have time for today. But of course, the company will review all questions submitted today, and we'll publish those responses on the Investor Meet Company platform as soon as is practical. Chris, James, I know investor feedback is important to you guys, and I'll shortly redirect investors to provide you with their thoughts and expectations. But I guess before doing so, if I could ask you just for a few closing comments to wrap up with, and then I'll redirect investors. Thank you.
Yes, Mark. Thank you very much, and thanks very much for the opportunity to take in here with IMC. It's our first opportunity, and I think we've been pleased to talk about the progress that has been made over the last couple of years, despite the challenges of COVID-19 and oil and gas market conditions. But the exciting prospects for the group are very much the opportunity in hydrogen refueling, green storage, and transportables, where Chesterfield Special Cylinders has some fantastic products. 100 years of expertise, and we're really optimistic about the years ahead and the impact that's going to have, positive impact that's going to have on Chesterfield Cylinders and the group. We're also really encouraged by what we're seeing at the moment from our OEM customers in oil and gas after a couple of very difficult years. We've pushed on with the improvements to our PMC business, and now with a much more diversified customer base and a broader range of products and more efficient sites, we're optimistic going into 2022 for that division as well. And we appreciate very much the strong support we have from all of our shareholders, those institutional shareholders, but of course also the many private individuals that have backed the business and Pressure Technologies since its IPO in 2007 and continue to do so today. So we look forward to the next opportunity to brief on progress, and with the restrictions now coming down on COVID, we're determined, as we were in 2019, at opening our sites for open days and come and see some of our engineering in action. We look forward to talking about announcing those open days in the year ahead.
That's great.
And I'll just say thanks very much to everybody for joining, and all the best for 2022.
That's great. Chris, James, thank you very much indeed for updating investors this afternoon. Can I please ask investors not to close the session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Pressure Technologies PLC, we'd like to thank you for attending today's presentation. Good afternoon to you all.